Hi, welcome to this guide to depreciation and specifically depreciation with the straight line method. We're going to talk about some theory and go through an example and also the journey of the journal entry for depreciation. So this video includes an explanation of depreciation, what it is and what it isn't. It's just a quick guide. There's also the different depreciation methods and what they all have in common. Then we'll go through a straight line depreciation example, followed by the journal entry for recording straight line depreciation, and then we'll just do a final review. Okay, so what is depreciation? It's better to talk about what it isn't before we talk about what it is. So there are some common misconceptions, and this addresses these. So depreciation does not measure non-current asset valuation. Depreciation has nothing to do with valuation. You'll often find that non-current assets, if they were sold, they're not normally sold for cost minus depreciation. Very rarely does that equal. Whether you're using the revaluation method or the cost method, you'll find that the actual valuation can be quite different. Secondly, depreciation does not represent a store of cash for non-current asset replacement. Specifically, depreciation journal entries are non-cash adjustments. It has nothing to do with cash or a cash reserve or anything to do with that. So they're the two main misconceptions. So let's talk about what it is. So depreciation is an expense. It's an application of the matching principle for non-current assets. The matching principle is a fundamental accounting concept that states revenue must be matched to expenses and vice versa. So depreciation is an expense being matched to the revenue the non-current asset generates. So in other words, the non-current asset is purchased, it goes straight onto the balance sheet, and that non-current asset will help you earn income over time. The expense to match against that income being earned over time is the depreciation. It's the matching expense. Okay, secondly, depreciation links balance sheet assets to the income statement. You may not know that everything on the balance sheet will eventually end up flowing through the income statement. Whether it's today or next month or in 10 years' time, everything that is on the balance sheet will end up in the income statement. So depreciation is a way for assets that go straight to the balance sheet to flow through to the income statement. But essentially, it's an expense of the matching principle. Now, what are the three main depreciation methods? There's the straight line method, which we're going to talk about today, and that's where you have the same depreciation expense each period. Secondly, there's the reducing balance method, and that's a different calculation where you have higher levels of depreciation early on, and then the depreciation tapers out over time. And then finally, the third main method is the units of production method. And that's where the depreciation expense depends on how much of the asset was used in that particular accounting period. But whatever method of depreciation you use, all three methods use the same three core pieces of data for the depreciation calculation. Firstly, you must know the cost of the asset, and that's the monetary amount. You must know the estimated useful life of the non-current asset, whether that's in a period of time or particular units of use, perhaps kilometres driven for a truck. And then thirdly, there must be a residual or salvage value, which is also a monetary amount. That's how much the asset is going to be worth once the asset has finished its estimated useful life. How much you could sell the lifeless asset for, or how much value you could receive at the end after its useful life. Okay, so that's the theory covered. Let's get into a straight line depreciation example. So here's the scenario. Smith & Co. is an online retailer of computer hardware. Smith & Co. buys a truck for $20,000 to deliver orders. The truck is expected to last 3 years before it can no longer run and Smith & Co. can no longer use it. And then after 3 years, Smith & Co. can get $4,000 for the truck parts from an auto workshop. So in that scenario, we had the three key pieces of data. The cost of the asset was what it was purchased for, and that was $20,000. The estimated useful life was 3 years. Smith & Co. could use it for 3 years before it had to be replaced or sold. And then finally, the residual or salvage value was $4,000. So after 3 years, they could get the truck parts sold for a value of $4,000 to that auto workshop. Now let's work out how much depreciation we use in the straight line method. Here's the formula. Annual depreciation is cost minus residual value, and that's all divided by the estimated useful life. So cost minus residual value on top, divided by estimated useful life. And let's plug in the numbers. Here we have $20,000 cost minus $4,000 residual value, divided by 3 years as the estimated useful life. And that calculates for an annual depreciation expense of $5,333.33. So here's the depreciation schedule. We have the end of year. We have 1, 2, and 3, so 3 years. We have the depreciation expense per year. And then we have the book value, which is simply the current book value minus the depreciation expense for that year. So we have year 1, depreciation expense, $5,333.33, and book value of $14,666.67, which is simply $20,000, which is the cost, minus the depreciation. Year 2, end of year 2, it's repeated, but this time the book value starts at $14,666 and ends up at $9,333. And then finally, at the end of its useful life, after the end of year 3, you can see that the book value is $9,333.34 minus $5,333.33, which is the depreciation expense, and the final book value prior to it being sold to the auto workshop is $4,000.01. And there is that 1 cent there because of all of those threes in this calculation. That's just a rounding error from all of the threes in the calculation. So you'll see at the end of the estimated useful life of 3 years, the book value will be exactly equal to the residual value. And finally, the journal entry. So at the end of each year, assuming that you only adjust your accounts when you record your depreciation annually, you have a debit depreciation expense plus the amount, and a credit of accumulated depreciation $5,333.33. And we credit this accumulated depreciation to the actual specific asset of property, plant, and equipment. So a truck is part of property, plant, and equipment, and for each individual account, we have a specific accumulated depreciation for that specific non-current asset account. It's not one giant pool between all of your non-current assets. Okay, let's review what we covered. Depreciation is an expense for non-current assets as part of the matching principle. The 3 main depreciation methods are straight line depreciation, reducing balance, and also units of production depreciation. The key pieces of data for any depreciation calculation are cost, estimated useful life, and then the residual or salvage value. To calculate straight line depreciation, you do cost minus residual value and then divide that calculation divided by the estimated useful life. And then finally, the journal entry for depreciation we covered was debit depreciation expense, credit accumulated depreciation. Okay, that's it. Thanks for your time. That's a quick guide to depreciation and specifically the straight line method. Hope you can give me a thumbs up. Have a great day.